private equity firms obsess over one ratio when buying companies: net debt to earnings before interest, taxes, depreciation, and amortization. It tells you how many years of earnings it takes to pay off debt. Companies below 2 times can pay off all net debt in under 2 years. That's the balance sheet flexibility. Private equity firms pay billions for. Net debt equals total debt minus cash and cash equivalents. A company with $5 billion in debt and $4 billion in cash has only $1 billion in net debt. Negative net debt means more cash than debt. That's the strongest position a balance sheet can be in. Many of the world's strongest companies sit here. They could write a check to eliminate all borrowings tomorrow and still have cash left over. We use net debt instead of gross debt because it captures real leverage exposure. Two companies can both carry $5 billion in gross debt. But if one sits on $4 billion in cash and the other has none, they're in completely different positions. The ratio itself is simple. Divide net debt by earnings before interest, taxes, depreciation, and amortization. A result of 2.0x means it would take 2 years of earnings to fully pay off the net debt position. The thresholds are well established. Negative values mean a net cash position, more cash than debt. 0 to 1 times is very conservative. 1 times to 2 times is healthy. 3 times to 5 times is typical for PE-backed leverage. Above 5 times enters distress territory. Investment-grade companies generally stay below 3 times. Above that threshold, credit ratings deteriorate and borrowing costs rise. Very negative values below -5 times can indicate unusual situations: recent capital raises not yet deployed, companies accumulating cash without productive uses, or near zero earnings before interest, taxes, depreciation, and amortization, making the ratio extreme. We filter these out in our screen. PE firms love this ratio for 3 reasons. First, deleveraging capacity. A company at 2 times can potentially handle leverage up to 4 times or 5 times, creating room for acquisition debt. Second, cash flow visibility. Lower ratios mean more cushion to service debt during downturns. Third, comparability. The ratio normalizes across industries and capital structures, so a tech company and a manufacturer can sit on the same scale. The real-world spread is dramatic. Alphabet sits at -1.8x, Meta at -0.9x, Apple at 0.5x. These companies could pay off all debt from cash on hand, all with minimal impact to operations. That flexibility is precisely what PE firms screen for when evaluating acquisition targets. Let's find the strongest balance sheets on the market right now. One query filters for companies that can pay off all net debt in under 2 years of earnings, with profitability and solvency checks built in. We join 3 tables: key metrics for the core leverage and profitability ratios, financial ratios for the debt-to-equity solvency check, and profile for company names. The between -5 and 2 clause is doing the core work. The upper bound of 2 times means every company in the results can pay off its net debt in under 2 years of earnings. The lower bound of -5 filters out unusual situations like recent initial public offerings with cash raises that haven't been deployed, or earnings before interest, taxes, depreciation, and amortization anomalies that make the ratio extreme. Slightly negative to near zero is the sweet spot, where the company has ample flexibility without sitting on unproductive cash. The return on equity filter at 10% ensures the company generates solid profits from shareholder capital. Low leverage combined with high profitability means conservatism from strength. Without this filter, the screen catches companies that look low leverage only because they recently raised equity and haven't deployed it yet. The debt-to-equity ratio filter, set to greater than or equal to 0, filters out distressed companies with accumulated losses exceeding equity. A company can show attractive net debt to earnings before interest, taxes, depreciation, and amortization while having negative book value. And that's not the kind of balance sheet flexibility we're looking for. The market cap floor of $1 billion ensures we're looking at companies with audited financials, liquid trading, and meaningful leverage ratios. Smaller companies often have unusual capital structures that make the ratio less reliable. The screen produces a mix of companies. Near the top sit names with the most extreme net cash positions relative to their earnings before interest, taxes, depreciation, and amortization, regional banks, tech services firms, specialty businesses with large cash reserves and modest operating earnings. These have ratios near -3 to -5. Further down the full list, more recognizable businesses qualify. Costco at negative 0.65x, where membership-driven cash flow keeps more cash than debt despite aggressive expansion. Nvidia near zero, where massive earnings growth has shrunk the ratio without deliberate debt reduction. Alphabet at 0.23x, Apple at 0.3x, Meta at 0.45x, all well below the 2 times threshold, meaning each could repay all net debt in well under a year of earnings. What doesn't show up is equally interesting. Utilities, real estate investment trusts, and heavily leveraged industries are absent. Those sectors use debt as a fundamental tool for capital allocation. Their absence isn't a flaw in the screen. It's the screen working as intended, filtering for companies where low leverage is a choice backed by strong earnings, not a structural feature of the industry. The screen gravitates toward businesses where operational strength drives the low ratio. When a company can cover its net debt in under 2 years of earnings while generating strong return on equity, that's a meaningful signal about management quality and business durability. This strategy has structural blind spots that no additional filter can fully address. Earnings before interest, taxes, depreciation, and amortization can be manipulated. The ratio depends entirely on the denominator, and earnings before interest, taxes, depreciation, and amortization is one of the most adjusted numbers in corporate finance. Companies routinely report adjusted earnings before interest, taxes, depreciation, and amortization. That strips out stock-based compensation, restructuring charges, and other recurring costs they prefer you didn't count. Add-backs inflate earnings before interest, taxes, depreciation, and amortization, which deflates the ratio and makes leverage look lighter than it actually is. A company at 2 times on reported earnings before interest, taxes, depreciation, and amortization might be at 3.5 times on a stricter definition. The ratio doesn't capture off-balance sheet obligations. Operating leases, pension liabilities, and contractual commitments don't show up in total debt for many companies. A retailer with $2 billion in operating lease obligations has real leverage that this screen completely misses. IFRS 16, the international accounting standard for leases, brought some of this onto the balance sheet, but not all of it. U.S. generally accepted accounting principles treatment still varies. It's also heavily sector-dependent. Tech companies naturally carry low leverage because their business models are asset-light and generate massive cash flows. Screening for low net debt to earnings before interest, taxes, depreciation, and amortization across all sectors is implicitly a bet on tech and away from capital-intensive industries. A utility at 3 times might be conservative for its sector, while a software company at 1 times might be unremarkable. Without sector relative benchmarking, the screen overweights industries where low leverage is the default, not a sign of quality, and the screen doesn't check earnings before interest, taxes, depreciation, and amortization trends. A net debt to earnings before interest, taxes, depreciation, and amortization of 1.5x looks solid today, but if earnings before interest, taxes, depreciation, and amortization is declining 20% annually, that ratio is headed to 2.5x or 3 times within 2 years. The snapshot nature of trailing 12-month data means you're always looking in the rearview mirror. That's the net debt to earnings before interest, taxes, depreciation, and amortization strategy, the ratio PE firms obsess over when evaluating acquisitions. Applied as a systematic screen for balance sheet flexibility, the SQL query is live on CetaResearch.com. You can adjust the leverage threshold, add sector filters, and cross-reference with other quality metrics. Link in the description. The full backtest testing whether low net debt to earnings before interest, taxes, depreciation, and amortization predicts returns is coming next. Subscribe so you don't miss it.